Let's go.
Hello, everyone, and welcome to Zephyr's Adjusted for Risk podcast from the shores of Lake Tahoe. I am Ryan Nauman, the market strategist here at Zephyr. 2025 was a great year for global financial markets as AI continued to be a hot theme and helped drive markets higher. I have on an industry expert who's going to share his outlook for 2026 and give his thoughts on if that AI bubble is about to burst or if it has more runway ahead of itself. But first, today's episode is sponsored by the award winning Zephyr, which helps investment professionals make more informed investment decisions on behalf of their clients. All right, enough from me. Let's go ahead and move on to the star of the show. I am very honored and excited to welcome Jim Besaw. Jim is a founding principal and chief investment officer at GenTrust. Jim, thank you so much for coming on the show. It's really an honor, really excited about this conversation. And can you please tell us a little bit more about yourself and GenTrust?
Sure. Thank you for having me, Ryan. I really appreciate you guys doing this with us and with everyone else here. Podcast is great to watch. So, GenTrust is a multifamily office started back in 2011. Myself and two of my partners grew out of the idea that we saw a lot of the big institutions had high levels of sophistication, but they also had high levels of conflict and often were not prioritizing their client needs. And a lot of the independents had no conflicts, but they also didn't have the sophistication because they didn't have the resources. So we thought our business would endeavor to accomplish both those, have as little conflicts as possible, but also the sophistication of some of the larger institutions out there.
Yeah, that's great. You're exactly right. There's that middle space there, right? That middle ground that often goes unnoticed or underserved. So you guys are doing a great job there. It's hard to believe, Jim, that we are talking about 2026 and we're 2 weeks into 2026 already. But let's talk about your 2026 outlook. What do you think is in store moving forward?
Yeah, no, I also can't believe it's 2026. So I started my career in 1996, and I'm pretty sure at some point in that year I bought a 30-year bond that's maturing sometime this year. So it feels like it's so long into the future. Yeah, so our we published our 26 outlook in mid-December. I usually spend at least a few weeks reading as many different outlooks as I can out there, different organizations and stuff. And it's funny how over the years, the variety and the topics that they cover is really converged. And now everyone's outlook is like half on AI and then a smattering of other things that they decide to fill in. So it's hard not to talk about AI when it comes to markets because it's clearly the number one force that's driving everything, especially in US markets. So that's a big part of what our outlook is. We also talk a lot about the dollar and the overall movement across nations away from dollars and into other currencies and what that trend might look like if it continues. And the last main topic that we talk about is what we call advancements in wealth management. That makes it sound very scientific, but it's new tools that wealth managers have in the last few years that weren't available to the broad market years ago, which I think is makes it an exciting time to be in this space because the value that you can add to your clients are significantly more than what they were a decade ago.
Yeah, Jim, that's great. And you're exactly right about that outlook slide. Sometimes you read them and they're just different phrases
Right.
for kind
Right.
of the same thing. But you guys have a very interesting take on AI. And we're going to get to that shortly. Also about the advancements in in the wealth management space, which is really exciting for wealth managers and our financial advisors that are listening. Let's talk about the dollar though, real quick. It was a tough year for the dollar. Does that concern you? Do you think moving forward a little bit, does the weakening of the dollar concern you? Obviously, it's helped the international trade and emerging market trade, but there's some concerns there. And then with a budget that, continues to balloon.
Yeah, I would say that we're not concerned about it. I think it's almost refreshing to see a little beta version across markets. I tend to get very nervous when things just move in one direction because I don't think that's healthy for anyone. So, we benchmark clients to global equities unless they explicitly ask us for US only. And we have within our, at least our equity basket, a fair amount of non-dollar exposure that's been consistent. So it's nice for once to just have the standard AQUI allocation outperform the US large cap, because S&P became a very difficult benchmark to beat from any metric for many years. And so it's nice to see Europe up 30 some percent and Asia up 30 some percent versus the US. So we're not concerned about it from a portfolio positioning perspective. I think our take on it is that these currency cycles generally are pretty long. They last 15 to 20 years, which is much longer than a credit cycle or market cycle, economic cycle, business cycle. Those are all 3 to 7 or 8 years. So currency cycles tend to last much longer. And a lot of the components that are in place right now tend to be the sort of components that you see at turning points. So it's not totally surprising that you saw a 9% depreciation in the dollar in 2025. The short summary, to not bore your listeners with a bunch of currency talk, is that if this cycle were to continue, they generally result in somewhere on the order of 30 to 40% moves. So we might only be, but it takes 15 years. We might have more to go in this trade. And I think it's healthy overall because you're seeing capital balanced across markets and stuff, where it felt like for so long there was just a one-way trade into a small set of US assets.
That's a very good point. Finally, those diversifiers out there, the people that, have lived and died by diversification, now they're being rewarded
Right.
finally after years of US supremacy and just do mega tech. Now, see, diversification is back alive and it's working really
Yes.
well. And like you
Free
say,
lunches.
yeah, exactly, exactly. So let's talk about AI. You mentioned it, like you said, when you're talking about investment themes, you have to talk about AI, whether you want to or not. And it was the hottest theme in 2025 and even before then. Do you think that hot AI trade is going to continue in 2026, or those valuations are lofty? Do you think they're going to be a headwind?
Yeah. So it's always difficult to call tops and bottoms and really market direction overall. So I wouldn't necessarily make the proclamation that we've seen the highs for some of these names. What I would say is that the risk reward of being overly concentrated in is making less and less sense. It's one thing to own the Mag 7 when their Ps were in the 20s or 10s and the cycle was first starting and there wasn't a lot of expectation built in. But I think now, given where most of these are valued, not just that, but also the circular nature of the investment cycle between a lot of these companies is particularly worrisome. The thing to recognize with the large mega cap tech names is that a lot of what they're doing now really changes their business model from what it was. The reason why people were willing to give these companies very high valuations in the past is because they had very capital light, maybe with the exception of Amazon, they had very capital light businesses that could run at very high margins. Like that's totally changing, right? If all of these companies have to invest significant capital to support the training of their models and things like that. And so I think there's a lot of things going on in that space that are troubling. I think that one story that came out about a year ago was the DeepSeek story in China. And when it first came out, we actually thought it was a relatively big deal, and we wrote about it a couple of times. And it never really caught on. I think that because the AI trade, you had Liberation Day, and then the AI trade just dominated the second or the last two-thirds of the year. But what DeepSeek showed is that there's ways in which math can beat materials. And I use that explicit expression because I have a friend who's a material sciences professor, and I always talk to him about chips and AI and things like that. And he said to me, that whole world is a race between mathematicians coming up with faster algos and material sciences professors coming up with materials that can cool faster and support more calculations and stuff. And he's a material sciences professor, and I think the mathematicians are going to win. And I said, if the mathematicians win, what happens? He goes, there's going to be a lot of dormant data centers across the world. People are going to build things that just aren't going to be needed. And I think there's also other ways to solve the same problem. I look at companies like Apple, right? Apple has very explicitly said that they think the future is distributed compute, which was funny because I remember when I first started in the industry 30 some years ago, the it was a big thing that you weren't having to run a massive program on your local computer. You could actually farm it out to other machines. And so this idea of distributed computing became a really important concept. What Apple's talking about is instead of having all of these calculations done in data centers that are massive spends and projects, that you can instead use all the devices. Everyone's Apple Watch and iPhone would be used as local calculation agents for a lot of the things that are being done. I think that's really interesting because that's a different perspective from a very well knowledged company that results in you not needing the massive spend that a lot of these companies are at least reporting that they're going to undertake over the next 5 years. $3 trillion of spending over the next 5 years. What do you think the ROI on that $3 trillion is going to be? I guarantee anybody that's in the finance department of those companies is probably underwriting it to 15%. 15% on $3 trillion is a lot of money. And that means a lot of money would have to go to AI spend for that to be justified. Long story short, I think that we see a lot of optimism that's built into this market, and we just don't think that translates into the same sort of it translates into negative asymmetry for clients that are overly exposed, which is most people, because if you just bought a portfolio at any time in the last 10 years and haven't touched it, you now own a ton of AI exposure.
Yeah, Jim, that's fantastic. And we'll talk about that exposure and the high concentration. In your outlook, I love this term that you use, prisoner's dilemma.
Yeah,
And what you just talked about, right? Where these companies that traditionally have strong balance sheets, now they're spending a lot. And like you said, they have to, or
you
they
have to.
feel that they have to keep
Absolutely.
up. But do you think that that spending like on data centers, you think is a little premature?
I don't know if it's premature. I just think that the levels of spending are just massive. If you would have told me 3 years ago, companies are going to be announcing every day 100 billion here, 500 billion there, I'm like, those numbers are bigger than 98% of the companies out there. Like, what, first of all, what companies have that amount of money to spend, and how are they able to take that sort of risk without the market pricing an appropriate premium on it? And that's what you've seen. If any of your listeners have been following the Oracle CDS market, they are the company that's probably they're not technically Mag 7, but of the mega cap techs, been the poster child for people worried about excess spend and leverage that's going to have to take place to make these things possible. Their CDS went from 20 or 30 out to really wide levels. To the market's just saying, listen, you're a riskier company than you were in the past. If you say the rest of the Mag 7 have any of that same sort of exposure, why are the valuations not lower? Why is there not more risk being priced into these things? So I think it's certainly a very interesting time to be in these markets and looking at things.
I like how you said too earlier about how just the return risk metrics aren't, they're getting murky, right? It's not as high as it was at trade-off. And like you said, maybe it's not going to burst or anything like that, but you just, that risk seems to be increasing while the return might be flattening out a little bit, potential return. So like how you said then, speaking of risk, and you said it earlier, markets continue to be highly concentrated in AI focused names. Like you say, you buy ETF, mutual fund, you probably have more exposure to AI names than you think, especially then you buy a couple growth ETFs,
Yeah.
and before you know it, you've got a big concentration there. What impact does that concentration have on markets? Should people be a little bit concerned there?
Yeah, I think if you think about the simple cycle, it exaggerates things in both directions. So on the way up, it's going to make things feel like butter, right? And that's really how markets have felt, because if you're along these names and the names that are going up the most are becoming a bigger and bigger percentage of the holdings that you have. Obviously, the holdings you have, if you look at the S&P index funds performances, you're like, these are top decile 5 year, 10 year time period over the last 100 years. But it also works the other way, right? When you have the delevering of those sort of names. And I think, again, not trying to call market tops or bottoms, but I think in our mind, moving portfolios away from being overly concentrated to a handful of names what's one of the first things that you learn in investing or finance? They say, don't put all your eggs in one basket. You've got seven really big eggs in most people's baskets right now. And if something happens to half of those, it's going to be very problematic for markets in general. And there's also within the index now, there's starting to become differences of approaches and competition, right? If you just look at there's the OpenAI NVIDIA ecosystem, and then there's like the Google ecosystem. They're both trying to accomplish the same thing, which is create models that everyone wants to use to do all their stuff. There's probably not going to be two winners, right? There's most likely going to be one winner, and if there's one winner in that outcome, then the other company's probably not going to go up. It's probably not going to be a very pleasant several year period for them. So I think given that you're starting to see that, and the other thing that we always think about is just simply I don't want to misuse a statistics term, law of large numbers, but the market caps of a lot of these companies are starting to approach levels where they're already bigger than most countries, right? And they're becoming big enough that there's government starts to worry about it, right? It's like we don't want companies that are bigger than the government and everything else that we're in charge of, and they can certainly take action against these companies. I'm not saying that's going to happen in the rest of Trump's term or even after that. I'm just simply saying that there's a limit to how big these companies can get because the value of any stock is the present value of all of its future earnings. And if you say the value of the stock is bigger than everything else together, okay, how is everything else together going to spend more money than what it's worth? So there's definitely, when you start talking about $4 or $5 trillion companies, there's certainly limits to how much they're not going to be going up 100% a year regularly anymore, for sure, which is what people are mentally extrapolating because that's what they've experienced over the last 3 to 5 years.
Yeah, very good point. And I often talk too about how, yes, it's invest in the S&P 500, the spider, but you should start maybe looking at, instead of the cap weighted indices, if you're just a passive, look more at the equal weighted, right? There's more diversification there. And once the breadth of the market starts increasing, which I think we've seen a little bit, that equal weight will help you.
That's right. We've been about a year and a half ago, we started moving the client portfolios. It's hard because you don't want to sell things that are up a lot when you're a taxable investor. And obviously, large cap is up a lot. What we've been doing is taking new money and having it go towards equal weight non-US markets. As I mentioned, we're benchmarked to global equities, which is still 60% US, and it's still the majority of that 60 is large cap, and 40% of that is the Mag 7. So you still end up with something that looks like 20 to 25% seven companies. But if you take a little bit of the large cap, you move it to equal weight, you take a little bit of the US and move it to non-US, and you think about the concentration in intelligent ways. For example, we have we've been big advocates of uranium, which when you said uranium to somebody 4 or 5 years ago, they're like, what are you talking about? Like the yellow cake nuclear stuff? And we're like, yeah, that's going to be really important. You look at that now, like that is 100% correlated to the AI trade, right? It's all AI, data centers, energy, things like that. So we've started to cut back some of our exposure in uranium. We still own it because we still think it's a viable long-term energy source that's really important. You have to keep selling it every 6 months because it goes up 50%. So to be prudent and take risk off the table across the board and think, how would my whole portfolio behave in a really bad environment for AI? And if you literally go through and look at all the line items and all the exposures, you'd start to realize there's a lot of stuff that's pretty correlated.
Yeah, very good point, Jim. So let listeners out there, financial advisors, maybe they're getting a little uneasy on this AI trade. They've had some really big winners, done really well over the past couple of years. They want to, maybe clients are getting a little bit older, take some risk off, lock in those gains. But then with that, like you just said, there's that potential for a lot of capital gains and all those increased taxes, especially for those taxable accounts. What are some strategies that maybe financial advisors can consider when their clients are trying to limit those large capital gains if they start selling some of these big AI winners?
Yeah, for sure. That's a great point. And I think it's if you sell something that has a 500% embedded gain, the taxes you pay, you're making a pretty big bet on whatever you invest in that's not that is going to outperform that for a long time in a very large amount. So it's certainly a difficult decision advisors face. My background is in options. That was my original. I was never in wealth management before. I was always in sales and trading. And so being able to look at the options market and see what is available there in terms of managing risk is a very important tool that we have in our toolkit for managing client portfolios. One of the interesting things is, given how aggressively the Mag 7 names have moved up really since 2022, there's a lot of retail investors that are buying calls on those names. So they are increasing the value of the upside on a lot of these names. And as a result, the puts look more attractive. So what we've been doing for a lot of our clients is basically collaring the same way that you would do if a client had a concentrated stock position. We've been collaring the Mag 7 exposure they have inside of their diversified ETFs as a way of reducing risk. Because what it does, in a lot of cases, you can cap the downside on these names at 10 to 15%, but the upside that you're giving away is only above 30. So you can get great risk reward. What other asset do you have that you could go up 30 but not go down more than 10 to 15? There's not many of those out there that you can invest in. And especially when you have an environment like this where the valuations make it very difficult for it to go up by 50 to 100%, it makes a lot of sense. So we've been doing that for client portfolios now for a period of time. One of the other tools that I think people will probably start to use a fair amount is doing things like exchange funds or 351 exchanges, taking a basket of concentrated stocks that they have. Now, if you're doing a 351, you're limited to how concentrated it can be. But if you're contributing shares to an exchange fund, you might not have that same sort of requirement. Exchange funds are inundated with Mag 7 names, though, right? Because most people has a lot of those. So there's limits on that, but certainly being able to do like a 351 exchange is something that is very interesting for a lot of clients that are dealing with these sort of exposures. And there you're not paying capital gains, you're investing in something that will be more diversified going forward. I think you're already starting to see, you mentioned equal weight S&P. You're already starting to see, I forget it was if it was Spire or iShares, but somebody was advertising a non-tech S&P 500. So like you own the rest of the S&P 500 or a historical weighted S&P 500 instead of market cap weighted. There's all these variations that are coming to market now on ways to avoid the overly concentrated risk that a general market cap weighted index is providing you right now.
Yeah, that's interesting. It goes back to what you said at the opening of the conversation too about the innovation in the wealth management space. And it really helps diversification. When I started 20 years ago, it was stocks, mutual funds, and maybe a little bit of
That's
ETFs,
right.
and that's it. Now, all the private markets, interval funds, a lot of things there that help financial advisors increase their toolkit.
That's
Are you guys doing anything to help partner multifamily office partner with financial advisors to help them make these decisions and build portfolios that might increase some of these strategies that maybe they don't have access to?
Yeah, absolutely. So that's a great point. The positive side is that you have all these amazing innovations that are happening in the world that's giving advisors lots of tools to be able to manage stuff. The flip side is advisors are already really busy. And even if they're using AI to make their life easier, like going through five new ETFs every day that are coming to market and understanding all the nuances of it, it's becoming very difficult. We have part of our business is an OCIO. We call it CIOP, CIO partnership. Plus, it's not just simply an outsourced CIO. We actually want to partner with the firms that we engage with. And a lot of what we do for them is really helping them understand the marketplace and how things are changing, because they've got plenty of work to do managing their clients and growing their business and everything else they do. Having our expertise and our kind of research staff and stuff to help them figure out what are the new things that are coming out. 8 or 9 out of every 10 things that come out is probably not worth it, is garbage, but helping them find the one or two tools that they can add that really adds value to their clients is great. So that part of our business has been growing extremely fast recently, just simply people aware of, I need more help. I can't keep up with, to your point, back in the old days, you get one new ETF a month and you could take a look at it and make a decision. Now it's 5 a day. Like, how do I keep track of all these things and really be aware of what's going on? So our CIO partnership has been a great way for us to take the research that we're doing and share it with other firms that we partner with.
Yeah, that's great, Jim. And like you said, I I have a hard time keeping up with all the innovation, just whether it's just technology offerings, investment offerings. I can't imagine like a financial advisor who they're also have to manage the relationship and then try and stay on top of all the innovation. And like you said, it's really good. I love it, but it's a double-edged sword here. It makes it difficult to just do your day job.
That's right. That's right. You don't want a night job too. And tracking the ETF universe is third shift for everyone.
All right, Jim, I know you don't like calling the tops or bottoms. You don't have to do that, but let's just finish this conversation off with, and you mentioned it throughout the conversation, kind of your portfolio positioning. But what are your thoughts moving forward for 2026 on you think the best positioning is for investment portfolios?
Yeah, I think, like I said, we don't generally take a lot of risk in terms of being dramatically underweight or dramatically overweight. Super asset classes is what we call them, like equities or fixed income. It's just very difficult. Your Sharpe ratio or your ability to do that consistently is extremely low. So most of our risk is really selective in terms of the sort of things we do. I would say versus a benchmark portfolio. Obviously, if we're doing collars on the Mag 7, that's naturally putting us underweight Mag 7 exposure. We probably have more non-US equity exposure than your typical investment advisor, especially if they started mainly US and that's only grown. We have 30-40% of our client exposure outside of the US. On the fixed income side, it's really difficult because spreads are so tight. And I think our view there is we're waiting to see what happens with the announcement of the Fed chair. I think the wrong name could actually create consequences that are worse than what's trying to be accomplished. Ultimately, President Trump is trying to move rates lower. If the world thinks that this person who is nominated is just simply going to do what he says and lower rates aggressively or try to convince the committee to lower rates aggressively, I think they could actually create the long end selling off, which is bad for. He's trying to get mortgage rates down too. If you have the 10-year selling off, it's not going to be helpful. So the fixed income side, we're very close to neutral. We don't have a lot of spread positions because spreads are so tight. So it's another way of being less on risk. And we've held a fair amount of, I mentioned uranium, gold exposure for client portfolios. Both of them are things that like you have to sell every 3 months because it just goes up. We haven't held silver exposure broadly in our client portfolios, which we're kicking ourselves because that's what 200 or 300% in the last 9 months. But it is something that we're constantly looking at. I think that there's a limit to the amount of client exposure to precious metals. I think one thing that is interesting is how gold is actually starting to finally behave like people think gold behaves at a time in which Bitcoin is flatlined. So all those people that were calling for Bitcoin being the digital gold of the next 10 years, like they really have to be questioning themselves in the last 6 to 9 months of price action because it's shown the opposite. That was probably too broad and not that specific, but people could read more on our website if they like to. So
Yeah, you guys have a lot of great content on your website. I did a little bit of research. Unlike what some people might think, I do some research before we get on.
for sure,
But at the end of the day, diversification.
that's what,
I think that's whether you diversify in gold, whatever that allocation is, some Bitcoin, crypto, diversify across asset class. Because finding alpha now, and it goes back to high concentration in the S&P and markets, finding alpha is hard, especially if you're underweight potentially those big AI names. So diversification can probably help that alpha generation, I would think.
for sure.
So, Jim, awesome conversation. Love talking markets. You bring a great different view on some of them, especially the AI trade that sometimes I don't think people really look at, but open their eyes to that. That's something they should consider when they're looking at AI and just investing in general. Thank you so much for coming
Thank
on.
you.
Really fun conversation. It was an honor and privilege. Where can our audience get more information about GenTrust?
Yeah, so our website is www.gentrustwm, so GenTrustWM.com, wealth management. And there's lots of stuff on there. So have a field day.
Fantastic. I'll include that link in the show notes also.
Great.
Also, great, Jim. Thank you. And
Thank you,
thank you
Ryan.
so much for listening to this episode of Zephyr's Adjusted for Risk podcast. You can watch all of our other episodes on the Zephyr YouTube channel and Spotify. Please be sure to like and subscribe to those channels and give us a follow on LinkedIn. Thank you very much and have a great rest of your week.
Thanks, Ryan.